In China, real estate isn't just a market, it's a financial behemoth. For decades, it was an economic engine that, with related industries, made up as much as a third of the entire country's GDP. It was the foundation of middle class wealth, the fuel for nonstop construction, and a symbol of unstoppable growth. For years, the world just watched in awe as entire cities seemed to rise from the dust. But now, a sound you can't hear is echoing across global financial markets. It's the subtle, terrifying tremor of the first critical domino beginning to wobble. A giant developer, once considered a pillar of strength and a household name across China, is buckling under the weight of its own debt. And this isn't just their problem, this is the start of a chain reaction, a contagion that is already quietly seeping through the world's financial arteries. It's programmed to find its way to your assets, your pension, and ultimately the value of your home. That first domino has just fallen. To really get the scale of what's unfolding, you have to look at the one company that was never supposed to fail, China Vanke. For years, while other developers took on reckless amounts of debt, Vanke was seen as the good student of the industry. It was state backed, with about a third of its shares held by the government owned Shenzhen Metro Group, a connection that was supposed to make it invincible. But that invincibility has worn off. In a recent move that sent shockwaves through the market, Vanke announced it was seeking to delay repayment on one of its bonds for the first time ever. This wasn't some small struggling company. This was a bellwether for the entire industry. The market reaction was immediate and brutal. Some of Vanke's bonds plunged by over 30%, forcing trading to be halted. Ratings agencies like S&P took notice, slashing Vanke's credit rating deep into junk territory to CCC-. They warned its financial commitments are now unsustainable, pointing to a looming bond maturity wall of about $1.6 billion that the company must pay by mid-2026, while forecasting negative cash flow during that time. This is the language of a company teetering on the brink. The significance here can't be overstated. If even Vanke, with its powerful state backing, is struggling to pay its bills, it signals the rot in China's property sector is far deeper and more systemic than anyone was willing to admit. This crisis didn't begin with Vanke, though. It started years ago, back in 2020, when Beijing got alarmed by the speculative frenzy and introduced the Three Red Lines policy, a regulatory straitjacket designed to force developers to get their debt under control. But instead of a controlled deflation, it pricked a bubble of historic proportions. The most infamous casualty was China Evergrande, the world's most indebted developer, which finally collapsed under a staggering $300 billion in liabilities and was ordered into liquidation by a Hong Kong court in early 2024. Its shares were delisted, and the once mighty giant vanished from the stock exchange. It was followed by a cascade of others. Country Garden, Kaiser Group, and Sunac all fell into default or painful restructurings. This isn't just about a few poorly managed companies. This is a fundamental crisis of the entire growth model. For decades, the system ran on a simple, dangerous idea: build now, sell later, and assume prices will always go up. Developers sold apartments years before they were built, using that cash to fund the next project. This created entire ghost cities, vast complexes of empty apartments, monuments to a belief in perpetual growth. Now that belief has shattered. Home prices across China have been falling, new housing starts have plummeted, and the inventory of unsold homes is swelling. Developers are desperate. The foundation of China's economy has a crack running right through it, and the tremors are just beginning to be felt. A crisis of this magnitude doesn't stay contained. It spreads like a virus through the interconnected pathways of the global financial system. This is the domino effect in action, and it happens in predictable, devastating stages. The first domino, sector-wide collapse. Vanke's stumble didn't just hurt Vanke, it sent a wave of fear across the entire property sector. When investors see a state backed giant buckle, they lose faith in everyone else. It's a classic crisis of confidence. The Hang Seng Mainland Properties Index, which tracks major Chinese developers, has been volatile, reflecting the market's deep anxiety. For other developers, this means the cost of borrowing money skyrockets if they can even get it. Analysts have noted that historically, almost every Chinese developer that has asked for a bond extension has ended up defaulting. Once that happens, they find it nearly impossible to get new financing. This creates a death spiral. They can't raise money to finish projects, which means they can't generate cash from sales, which means they can't pay old debts, leading to default. This cycle is now playing out across dozens of firms. The second domino, China's financial system. The next dominoes to fall are the institutions that bankrolled the boom, China's own banks. For years, they lent trillions to developers, often with real estate as the only collateral. At the same time, millions of ordinary Chinese citizens invested their life savings into wealth management products, which were complex investments heavily exposed to the property sector. Now, those loans are going bad. Non-performing loans at some of China's largest banks are surging. For example, Bank of Communications reported its property bad loan ratio jumped from 2.8% to nearly 5% in just 1 year. This financial stress is compounded by a social crisis. Across the country, a widespread mortgage boycott has seen homebuyers who prepaid for apartments refusing to pay for homes that may never be finished. This is a direct hit to the bank's balance sheets and a massive blow to consumer confidence, the lifeblood of any economy. With household wealth so tied to real estate, falling property values are vaporizing the savings of the middle class, causing them to pull back on spending. The third domino, global contagion. This is where the crisis breaks containment and becomes the world's problem. It travels through three main channels. First, there's direct financial exposure. Chinese developers didn't just borrow from local banks, they sold hundreds of billions of dollars in offshore bonds. Who bought them? Global investment funds, pension funds in Europe and America, and international banks, all chasing higher yields and believing the Chinese state would protect them. They were wrong. As developers default, these bonds become nearly worthless, blowing a multi-billion-dollar hole in the balance sheets of financial institutions thousands of miles away. Second is the collateral chain reaction. The global financial system is a web of interconnected leverage. Assets are used as collateral for loans, which are then used to buy other assets. Chinese developer bonds are embedded deep within these collateral chains. When their value suddenly plunges, it can trigger a margin call. Lenders demand more cash. If the borrower can't provide it, they're forced to sell other assets like US stocks or European bonds to raise the money. This forced selling can spread panic across seemingly unrelated markets. Third, and perhaps most importantly, is the global liquidity crunch. This crisis is hitting at a time when high interest rates around the world have already tightened credit. Now add a major shock from China. Banks that just took huge losses on Chinese bonds become highly risk averse. They hoard cash and reduce lending everywhere, not just in Asia. This makes it harder and more expensive for businesses and consumers in your country to get a loan, slowing the entire global economy. Understanding these connections is the first step to protecting yourself. This is an abstract theory. This is the hidden architecture shaping your mortgage rate, your job security, and your retirement plan. Global decisions made in places like Shenzhen ripple straight into your wallet, whether you see it happening or not. If you want to stay ahead of these global forces and understand what they actually mean for your money, make sure you subscribe and turn on notifications. And if you want even deeper analysis, the liquidity maps, the macro shifts, and the charts I can't fit into a video, join my free weekly market newsletter using the link in the description. Newsletter readers will also be the first to get access to my upcoming macro investing and trading classes the moment they're ready. Let's keep going. So, how does a collapsing developer on the other side of the world actually reach your front door? It's not an instant event, but a slow, grinding process that works through the mechanics of the global economy. First, the global credit crunch we mentioned. When international banks suffer massive losses, their appetite for risk evaporates. They tighten lending standards across the board. This can translate directly into higher mortgage rates and stricter requirements for homebuyers in the US, Europe, and elsewhere. Fewer people qualify for loans, and those who do pay more. This immediately cools housing demand. Second, the crisis cripples a major engine of global demand. A struggling Chinese economy buys less of everything. That means fewer cars from Germany, less iron ore from Australia, and fewer soybeans from the United States. This slowdown ripples through global supply chains, leading to lower corporate profits and eventually job losses in exporting countries. When people are worried about their jobs, they don't make huge purchases like a new house. Third, we could see capital flight and forced selling. While some wealthy Chinese investors are pulling money out of their collapsing domestic market to park it in safe haven assets like US real estate, that's only one side of the story. On the other side are large Chinese conglomerates who bought up commercial and luxury real estate all over the world during the boom years. As they face a liquidity crisis at home, they will be forced to sell these overseas assets. This could mean a sudden flood of commercial buildings in London or luxury condos in New York hitting the market all at once, putting downward pressure on prices. These three factors, a credit crunch, a global economic slowdown, and forced asset sales, combine to create a perfect storm for housing markets worldwide. It's true that many Western markets have different fundamentals than China. There isn't the same massive oversupply of homes. However, that doesn't make them immune. The 2008 financial crisis taught us that a housing crisis in one major economy can become a global financial crisis that drags everyone down. The transmission mechanism of financial contagion is very much the same. So, what happens next? The Chinese government is in an impossible position. It's attempting what many call a controlled demolition of the property bubble. Officials are trying to prevent all out panic by providing lifelines to some developers, while avoiding a massive bailout that would just reward reckless behavior. They have reportedly guided local governments to take a market oriented approach, a phrase many see as a code word for restructuring, not a state funded rescue. This is an incredibly delicate balancing act. The risk of a policy mistake is enormous. Do too little, and the crisis could spiral into a full-blown financial collapse. Do too much with stimulus, and they risk devaluing their currency and triggering a different kind of crisis. For those of us outside China, the key is not to panic, but to be aware. This is not financial advice, but a call for vigilance. Watch the credit markets. Pay attention to the health of major international banks, especially those with big exposure to Asia. Watch for signs of stress in global trade. The illusion of our globalized world is that we are all independent. The reality is we are all nodes in a deeply interconnected network. The events unfolding in China's property market are a stark reminder that a tremor in one part of that network will inevitably be felt by all. Understanding the path of that tremor is the first critical step in preparing for its impact. The chain reaction is no longer a theory, it has begun. The first domino, the myth of an ever-expanding Chinese property market, has already fallen. We are now watching as it tips into the second and third dominoes, the stability of China's financial system and the offshore bondholders who funded the frenzy. The tremor is moving through the global system, making credit tighter, slowing economic growth, and threatening asset values far from where it started. The question is no longer if the final dominoes, the housing markets and the rest of the world, will be affected. The question is when and how hard the impact will be. What are you seeing in your local market? Let me know your thoughts in the comments below.